This one-bedroom condo just sold for $616,000. The seller bought this pre-construction for $874,000. So they took a massive loss of $260,000 before selling costs and land transfer. With distressed sellers like this, people assume that it's a good time to jump back into the market if they could pick up a good deal. But even with these good deals, let's be real. Real estate investing hasn't been great. And it's still not great in 2025. There are some key variables that impact real estate investing. These are your mortgage rates and your rents that you can get for your property, and they have the biggest impact on the resulting cash flow for your investment property. In this video, I'll be showing you 2 live examples of how the math works out for real estate investing in 2025. Condo investors can lose thousands every month in cash flow, and I'm about to show you exactly why the numbers just do not work in 2025 for condos. My second example is investing in a freehold property in the Greater Toronto area. And this asset class may, just may, be a workable investment depending on the circumstances. So you'll want to stay tuned and watch to the very end to see whether real estate investing in 2025 works for you. Hi, my name is Zen, and if you're enjoying my data-driven and number-crunching real estate updates, be sure to like and subscribe. Let's get right into example number 1, a condo. So this first example will be a condo that's on the southeast corner of Yonge and Bloor on Charles Street. It's a brand new condo that basically just closed last year in 2024. This person sold it, probably lost their HST, lost their development charges, paid land transfer tax, paid selling costs, and this is before the $260,000 loss. Basically, they bought for like $1,600 a foot and they sold for like $1,150. Having said that, $1,150 a foot, it's kind of market for like a brand new product with no rent control, but does it make sense from an investing world? This is exactly what we're going to find out. So let's run through the exact numbers right here. So they bought this for $616, being the new buyers. Your taxes aren't assessed on this property yet. They're going to assess you at 1%, but it should be around like $3,500, no more than that. Your maintenance fee is for that. So assume you did a 20%, and I'm just using a mortgage rate that's an investor rate. So, but right now I'm seeing like 4.75. So that leaves you at your mortgage rate. Your condo fees is going to equal this over here. You have property insurance of about $50. So all in, assuming you're not a first-time home buyer, you have double land transfer tax. You're buying this for $142,000. Now it's costing you $3,300 to carry this thing, which is absolutely insane if you really think about it. Now, if I were to add the rental income on this, it's $2,300. You're minus $1,060. And even though you bought it off of someone who was distressed selling it, your cash flow numbers still not make any sense, right? And even if I have to be very, very generous about how this investment number works and see how much principal you're paying back, every single month, you're paying back $633 in principal, which when you add this up, you're still negative $400, give or take. So that's why I'm saying condos are going to be hard to make cash flow positive anytime soon if you're a cash flow investor. And then if you're a speculator, that's just a different story. But overall, I mean, like, it's a nice property, good finishes, a lot of nice wood, right? I mean, you have your galley kitchen. It's kind of on the petite size, but it's a 536 square foot condo. I mean, I don't know what else you expect from this, but this has full-size doors. The bathrooms are very nice. They're very trendy, very modern, right? It's very functional. Like, if I was trying to buy my first place and I were to buy it at 616 on the street, yeah, I would buy it. Like, as an end user, this makes total sense. But as an investor, yeah, probably not. Now, I'm going to show you my second example, which is going to be a freehold property. So the reason I'm showing you this is if we are cash flow investors and trying to make the numbers work, the only way to do this is you add more units, right? So I'm going to run through this example. So this is a property that is in Pickering. The person bought this for $842,000. And the taxes are this over here. There's no condo fees. I'm using exact same rates for everything. You will not have a condo fee, but you will have insurance that's a little bit higher. I think there's a hot water tank over here too. Let's just call it $30. I think it was $30. And if you were to rent this out, you can easily call it $2,500 upstairs, $1,800 downstairs. You don't have the land transfer tax over here, and then you get to $160 cash flow positive. Now, keep in mind, there's obviously going to be more maintenance with 2 units. The house is obviously a little bit older than a brand new condo. Like, this house is probably post-war, so we're probably looking at 30, 40 years. There may be additional maintenance that comes along with it. And if you want to put in a property manager, that also eat into the cost. But when you're looking at the spread between them, you're looking at a $1,200 spread. Can you put property management in place? And could that extra spread between them cover the maintenance? Possibly, right? It just really depends on what type of investor you really are. So let me show you some of the photos over here. So you can see it's like pretty no frills, right? Freshly painted. It's not like a brand new kitchen, but it's functional. It's large, 3 bedrooms upstairs, 1 washroom, your standard bungalow. Has carpet. You can change the light fixtures. You can just touch it a little bit, change some of the hardware to modernize it. I would probably put a mirror over here. And that's kind of side entrance, right? So downstairs, this is generally what it looks like. You can probably get a little bit, 18-ish for it. You can probably spruce it up by, giving them a non-shared washer dryer. It's nice. It has a carport too, right? Hey, it's me interrupting myself. Ready to make a move? Just one free call, no hassle, put decades of experience to work for you. But now let's run through some examples, right? Like, is it opportunistic if you were to buy something and chase the interest rate down? And that's a question a lot of people are asking me right now. So let's just duplicate, the example over here, and I'll give you some scenarios. So if in the example here, let's say rates come down, what some of the banks are predicting, like I said in my other videos, let's say they come down 1 whole percent. So you're at 3.75. This thing is still not going to cash flow positive. Right. And this is what I'm saying, like, it may not make sense for a lot of condo investors until basically the numbers actually work. Now, however, there are some people who may want to jump back in because if you factor in the amount of principal that you're paying back at 755, technically you're just break even. Right. And this is people who may have a long-term view of things and think that, if I hold out and buy at this point and I don't think, it's going to drop anymore, or maybe I find a good enough deal, maybe like this one, again, all subjective based on numbers and how people perceive the market. I can maybe ride that really big wave in 2028, 2029 when no completions are happening, right? But that's a really big assumption. Now, if you think the market's going to absolutely tank, like the economy is going to absolutely tank, and you have interest rates down by like 150 basis points, which again could be catastrophic, and you got to watch out for your job. But then you're looking at this one. So even at that point, the numbers, there's not cash flow positive, and they still haven't for some time. And that's kind of what I'm saying. It's very tough to make condos work unless people were just speculating that, the prices were going to run up. Now, if I run through the freehold example, let's kind of run through the interest rate example. If I were to drop it to these two ones in the same scenario, you can see the cash flow looks a little bit better, right? And there's more principal recapture over here by the tenant paying down the mortgage. Again, managing 2 units tends to be a little bit more like, advanced than managing just a condo, because condos are generally pretty easy to deal with because there's a concierge and there's condo fees attached to it. Now, here's another question that a lot of people ask me as well. Hey, Zen, I have more money. Can I put more capital down to make these things work? So I could say, yes, absolutely you can. So I have some people who would do 35% down. Maybe you're buying in a corporation, you have to do stated income, but you don't want to take it out of the corporation because you're going to pay taxes on it. So you can definitely do that, right? And then here are your numbers. You're still minus, but then, if you incorporate the equity pay down, it's not bad. Also keep in mind, some people are okay with a little bit of cash flow negative because it can help them write off some of their income that they're having, and it gives them an asset that's kind of break even. So it really just depends on kind of the financial situation of each person. Now, the thing that I will very much note is that most of your money really at the end of the day is going to come from appreciation. And your appreciation and how much money you make is going to be based on your leverage. So if you have 35% down, your leverage ratio is 3-to-1, meaning for every 1% that the market goes up, you get 3%. However, if you're at your 20% down, you leverage 5-to-1. So a 1% appreciation means 5% for you. So the more leverage you have in your property, the better off you are, right? And if the property goes, up. And this is why my base case has always been, you want to have a healthy amount of leverage that you're comfortable with, and you want the property to pay for itself. So that's kind of why, if it's cash flow positive, you're not paying too much out of pocket. But if you're going to have to pay into it every single month, and you're also at only 3-to-1 leverage, does that really make sense? It may for some, it may not for not. It really depends on each person's situation. Because at the end of the day, like, this is a lot of numbers, this is a lot of things to digest, but you always have to boil it down to, why are you investing in real estate? What is the end goal? What are you trying to accomplish with this in like 5 years, 10 years, 20 years, 25 years? Some people want to own something so that it'll be mortgage free by the time they retire, and it just becomes like an annuity. It pays you like a pension so that you can live off of that rent. Some people just want to use that as a store of value, and it's going to upset a lot of people, but there are a lot of people like that out there as well. So it really comes down to what is your end goal, and you try to line it up with all the options and the strategies out there in the current real estate market in 2025. And if it makes sense, you can pull the trigger. As you can see, freehold properties are where you can actually make a property break even on cash flow in the current landscape. The money to be made here is the ability to hold this property with a 20% down payment, which gives you a 5-to-1 leverage ratio, and to have it slowly appreciate and have the tenant pay down the mortgage. In addition, in the future, or depending on the municipality, you can build an additional suite, call it a basement suite, garden suite, laneway suite, whatever, on top of that property to make it cash flow even more. And for you to understand how to do that, you can watch this video here where I show you exactly how CMHC is giving you a free additional suite through a refinance. It's kind of wild, and you need a freehold property to pull this off. You just can't do it with a condo, which is even more reason to focus on this asset type. I'll see you in the next episode. And remember, your move, your future. See ya!